I'm in a place called St. Simon Island. It's a little place on the southern coast of Georgia. Geographically, it's really close to a place called Jekyll Island. Many of you may or may not know, but Jekyll Island is the birthplace of the Federal Reserve System. If you've read the book, The Creature from Jekyll Island, it's the birth of the system that's referenced by G. Edward Griffin, that book's author. The Federal Reserve was mandated to stabilize prices, maximize employment, and monitor long-term interest rates. They've done that over the years. We often see the Federal Open Market Committee talking about whether they're going to raise or lower rates. If you think back over the past 15 or 20 years, you've seen them in action. Remember back to the Great Recession, the economy, the banks collapsed, the economy was going in the toilet, and so the Federal Reserve took the lending rate from 5.5% down to close to 0%. That lending rate is basically what banks pay each other to borrow money. So the higher the cost of their borrowing, the higher the interest rate they have to charge the retail customers. That's you and me. So back in 2008, 2009, the interest rates were lowered down to near zero. It's been a great time for real estate investors since then. Around about 2016, the economy started heating up, and the Fed's job is to monitor inflation as well, or to try to curb inflation, so they started raising interest rates. That didn't last very long, and the interest rates have come down again. We're in a viral pandemic, interest rates are low. So if you think about that, if you're in the real estate world, interest rates make a big difference. Low interest rates allow you to buy a bigger property, more property, possibly cash flow better. For instance, if you have a single family home, or if you're going to buy a single family home, low interest rates help you buy more house. Most people buy a property or the home they're going to live in based on how much they can pay per month. The lower the interest rate, the more house you can buy. The higher the interest rate, the higher the payment, thus less of a house. On the flip side, if interest rates go too high, it's difficult for people to buy houses. That's negative if you want to buy a house. However, if you own rental property such as apartments or duplexes, that's a good thing for you at least, because those people will need to rent and they're going to need to have some place to rent from. As interest rates rise, if you have variable debt, that can be a problem, because when your readjustment period comes, your interest rate's going to adjust up. Thus that decreases your cash flow and somewhat decreases the value of your property at sale. So the Fed is something to watch. I try not to watch too much news, but I like to keep an eye on the Fed. It lets us know if interest rates are going to rise or fall, and it helps guide what you're going to do in your real estate. The good thing about real estate is it doesn't move super fast, so you can get that information, you can make some planning, you can do some long-term planning. So, while maybe it's not good to watch too much news sometimes, at least I try not to, it's good to keep an eye on the Fed, and it's good to have an idea of where interest rates are going and where the economy's going. So that's a 10,000 foot view of macroeconomics from a really cold St. Simon Island today. Anyway, till next time, this is Tom signing off.